Good morning, everybody. My name is Nicholas Cully. I'm the Chief Commercial Officer of the Sovereign Group. For those of you who attended our first webinar, you will know the sort of structure of this presentation today. For those of you who are new, this is the second of 3 webinars that we will be hosting over the next month on the topic of international mobility, private client and corporate services. During the last session, we discussed what pre-arrival considerations need to be made when clients return to their country of origin or another high tax jurisdiction. During today's session, we will be looking at what planning you need to do when you've already arrived. We'll be focusing on asset and wealth protection solutions, personal pensions for internationally mobile clients, specialised insurance cover, and maritime solutions for sea vessel enthusiasts. So before we get into the presentation, just a few house rules. If you have any questions, please do feel free to ask them during today's webinar, either through the Q&A or directly in the chat. I will try and find an appropriate juncture to ask said question, but if not, we will have time at the end for me to ask them to the speakers. The session will be recorded, is being recorded, and will be sent to all of you, whether you've been able to attend or not, after today's session. So we do hope that if you do have any further questions, that we will hear from you at a later date. Next slide, please. So these are the topics, as I've mentioned, that we're going to be covering. If you could just move to the next slide, because I've already covered this. We have a little wheel here just showing the topics that we are covering. So we covered some of these in the last session. Today, as you can see, if we move around the wheel, tax planning is covered in all 3 webinars. It's the sort of the theme that runs through all topics when private client and international structuring comes to light. So that will be covered again today. But we will also be adding in yacht and aircraft registration and management. Gabrielle will be talking about that a little bit later. And insurance services, Chloe's going to be speaking about that too. We will also be touching on pensions and retirement planning, but we will be focusing on that more during the next webinar. Next slide, please. So before I pass on to Simon Denton and Lawrence Lancaster to kick off today's proceedings, specialist tax planning for international clients is now more important than ever. If you don't get it right, it can have serious consequences, as most of you on this call will already know and hopefully haven't experienced yourselves. In today's session, as I said, we will look at how you and your clients can best navigate complex and ever-changing cross-border regulations whilst reducing your global tax burdens by skillfully structuring local and international arrangements for personal asset and wealth protection. We will look at how you can assess and reduce risk whilst remaining tax compliant in the countries where there is a tax connection. So Simon, who is Managing Director of our UK operations, one of our oldest offices and longest standing members of our team, Simon, and Lawrence Lancaster, who's our Group Tax Counsel based in Singapore. They spoke during the last session and they're going to be carrying on the themes now with a couple of case studies, and then we'll be passing over to Chloe, who will take us through some insurance considerations, and finally Gabrielle, who will take us through the Marine Services division. We will finish up with a case study that incorporates all of these different aspects of the Sovereign Group and of the private client issues that clients might be having. So without further ado, Simon, Lawrence, please, can you take it away with the next slide?
Thanks, Nick. I think this is you, Lawrence.
Yeah, so we're going to be starting off just taking it very high level, the trust as a concept. So trust concept, you obviously have assets that are settled into trust by the person who's called the settlor. You'll also see for US purposes, they're referred to as the founder. Sometimes, sorry, when you're using a foundation, they're often referred to, or they are referred to as a founder. For trust purposes, we refer to them as the settler. They transfer the ownership of the assets, legal ownership, to the trustee. And then the persons who benefit are obviously the beneficiaries, and the settler may be a beneficiary. Normally speaking, the trust, there'll be certainly all of the trusts that Sovereign will execute and set up and manage. There'll be a written trust deed that sets out the terms of the trust, and that is the legally binding document together with the local trust law that determines what the trustee can and can't do. Types of trust. You start off with a bare trust, which I would say isn't really even a trust at all. It's just a very, very simple arrangement where a person holds legal title to an asset, bare legal title. That's why it's called a bare trust. And somebody, the beneficiary, is the absolute owner of the asset. And the only thing that the trustee holds is bare legal title. Whilst that kind of, it isn't even really a trust, it's just a bare trust, as I've said, it is often used, and they can have all different types of uses. So whilst it's very simple, it is often used in practice for various things. Then you have fixed interest trusts. These are less common in terms of the trust that we establish here at Sovereign, but they are used certainly for UK property planning, where you're owning UK property through a trust. What a fixed interest means is that the beneficiary has a fixed right to the income that the trust fund, the trust property produces, and or the right to use the trust assets. So they typically have what's called an interest in possession, a fixed interest. The way we normally structure these is to have a beneficiary or beneficiaries with this fixed right to the income or use of the asset, with the capital, the actual property itself, typically held on a discretionary trust. So the advancements of the actual assets that are held within the trust are only made at the trustee's discretion, but in terms of the income that those assets yield, that is fixed. In contrast, you have discretionary trusts where both the income and the capital, so the trust assets are the capital, they produce income, they're both held on discretionary trust, which means that we have beneficiaries that are listed, but the trustees have discretion as to whether to apply the income and or the capital of the trust for the benefit of one of those beneficiaries. They do not have discretion. They cannot apply the fund to benefit anyone else aside from the beneficiaries. And as we've mentioned there, they will be guided by the memo of wishes, which is provided by the set law. So in a nutshell, that is a very, very simple overview of the trusts that we offer. We do offer other trusts, but this is a start. And if we just pop over to the next slide, it is going to be Simon.
Thanks, Lawrence. These are the reasons why, when, what, and where to use them, and asset protection and estate planning solutions. Actually, the taxation planning tends to come far further down the list. Trusts are not necessarily purely for tax planning. So I'll just guide you through the salient features of why a partner, a spouse, or both spouses, both partners would set up a trust. Wealth preservation is preservation, which is linked with asset protection later on in the slide, ensures that the family's wealth can continue in the event of a negative or even a positive situation, can be applied to specific purposes, can be applied to younger generation, as opposed to just one person gifting wealth to a younger generation, and hopefully they have enough wealth to survive on for the rest of their life, or worried about too much wealth going into a younger generation, not sure what they're going to do with it. And a trust is often structured to fund education, healthcare for much elderly parents, or grandparents even, and even for the younger generation, to purchase assets, as opposed to asset purchase being made in a particular name. And if a family, quite often a family is family members are resident in different countries, so the trust is therefore holding the assets, even setting up or financing a business startup, or contributing capital into a company that needs a bit of extra resource to take it to the next stage. Wealth preservation and continuation, highly regarded. Tax planning is on the map, and will facilitate tailored advice needed jurisdiction by jurisdiction. The famous territorial landscapes and the non-dom landscape are a little more certain for tax planning. There's a case study at the end of this, ladies and gentlemen, featuring all of what we're going to talk about today. But significant tax planning, starting with succession, inheritance tax planning, estate planning, The UK leads with almost the worst inheritance tax rate and the lowest threshold in the world. So IHT is a little more in focus compared with other jurisdictions. Then you come back to capital gains planning and income tax planning. So these trusts can actually benefit a settlor and their family for a variety of tax planning reasons. The next one I like, continue a family business, making sure it continues for future generations and not just the average when you pass down businesses to on retirement or on demise. Sometimes the business only continues for one more generation if you're lucky. A trust can be established and structured for entrepreneurs, being business owners, business managers, owner-managed businesses, SMEs, even larger corporates, so the business can continue in retirement when the founder or the spouses want to take a bit of a backward seat, or come an untimely demise, the business can continue, and for future generations, adult children, younger grandchildren, obviously. Asset protection, wealth protection, not overlapping with wealth preservation, is probably a fundamental reasons why a trust, an onshore trust, a midshore trust, and trusts do not have to be set up in tax havens. Trusts exist in the EU and in midshore jurisdictions such as Cyprus, Malta, Singapore, Hong Kong. Cover that later. And a trust
and
structure
also
is
obviously
like
the UK as well, Simon.
UK, sorry, for UK long-term UK residents, that those that have been in the UK for more than 10 years and are not leaving the UK, unlike a lot that left in the last few years. So providing greater asset protection rather than owning the assets directly, just relying on a will. A trust is definitely superior to a will. Forced heirship, the last point, when you are contrasting perhaps coming from a common law coming from a common law jurisdiction but living in a civil law jurisdiction, or coming from a civil law jurisdiction and being, immensely mobile, and also recognizing the Islamic tradition of forced heirship, which we cover very carefully because we have offices in the Middle East and we are Sharia law compliant, Sharia law friendly. In case also, not everyone has a typical marriage or celebrates a marriage. So a lot of couples are not married. We've got same-sex couples, alternative lifestyle groups, and trusts are really superior to will planning and estate planning and navigating around forced heirship. Because in forced heirship, when jurisdictions where there are forced heirships and are not so welcoming of alternative lifestyle arrangements, where assets have to go to in certain proportions to a surviving seedy members of family. Again, a trust can easily navigate this and to good effect. And there's we've had plenty of experience in structuring trusts for expatriate clients onshore, midshore, and offshore. Over to Lawrence. Case study. Next slide, please.
Thanks, Simon. So we're now flipping over to UK and the concept of excluded property trusts. You here the key is that you have to have the settler must be a non-long-term UK resident. So they cannot be a long-term UK resident, and that generally means that they've been non-UK resident for 10 or more of the previous tax years. So 10 tax years or more of non-residence means that they're not a long-term resident, and they're able to settle assets into an excluded property trust, overseas assets, I should say, without attracting any UK tax charge or reporting. And what they're settling in is what we call excluded property for inheritance tax purposes. As I say, that moves in without any UK tax or reporting, and then it becomes an excluded property trust, an EPT. So here you see a vanilla EPT, plain vanilla. We've got sovereign as professional trustees. These can also be set up as private trust companies where the client can, the settlor, I should say, has some control over the trust that the SPV, the company that acts as the trustee of the trust. But in this, it's just very straightforward. Sovereign act as trustee, and this would be we typically set these up in the Isle of Man Guernsey, and here where I am today in Hong Kong. They're the offices that where we tend to set these trusts up, but we can set them up in any one of our trustee companies where we're licensed to provide trustee services, of which I think there's 7. But they're the 3 typical jurisdictions. In terms of the beneficiaries, remember they're the ones who can benefit from the trust fund. The settler can be a beneficiary along with the settler's spouse and children. And typically you would have a clause in to say lineal descendants, so that would capture grandchildren, great-grandchildren, etc. You see there the assets that are held within the trust fund. We've got cash at bank, must be overseas, an overseas bank account. So that means a non-UK branch of the bank in question. So Hong Kong, Singapore, Isle of Man, etc. is fine. A HSBC bank account in the Strand, not fine, because that would be a UK asset. Again, investment companies can invest in any company apart from one in the UK. So any UK listed shares, anything like that, UK companies are a no-no with EPT planning. It all has to be foreign investments. Again, you can have trading companies here, but again, just must be non-UK assets. You can also, we should just have property in there that has been deleted. You can hold property through excluded property trust, but again, it must be overseas property. If you're looking at investing in UK property through these, you cannot use residential property. You can still use commercial property through an overseas company. That is still an excluded property trust, as long as you buy the property through the company and you don't transfer in a pre-existing property. That won't work. And we typically use Isle of Man companies for that planning, where Simon is today. So that's just a canter through very simple EPT. So we can now move on to the next slide.
That's you, Lawrence, to introduce.
Yeah, sure. So the sister structure of a trust is a foundation. I mentioned earlier the concept of a founder. So that's the equivalent of a set law of a trust. Foundations are a feature of civil law jurisdictions. We don't have them in the UK at all. They're not recognised. But most overseas foundations for UK purposes are treated as trusts. But you wouldn't be able to set up a UK foundation because they don't exist under English law. So it's a strange structure, a unique structure in the sense that it's actually set up as a company. It has separate legal personality, but the beneficiaries are not the shareholders. They're actually akin to a discretionary trust, where the people who have the right to benefit are beneficiaries, like a trust, and you have essentially this foundation council, which is the equivalent to a trustee, and the council is able to confer benefits on the beneficiaries of the foundation by exercising their discretion. So very much like a trust, and not operating in a company where directors are not able to just pay benefits out in that way. It's very strict governance requirements with companies. So it has separate legal personality. So you have a company wrapper, but it actually operates like a trust. Remember that a trust is a relationship that exists between the trustee and the beneficiaries, and all the duties and everything that the trustee owes to those beneficiaries. A foundation actually has, it's a company, it has real personality. And for settlers, for founders who are based in civil law jurisdictions, that often is a lot more appealing to them than a trust, where they can find it quite hard to understand that you have this division between legal ownership of a trustee and then beneficiaries owning in equity. It's easier to understand with a foundation that you've got that company wrapper there. So in terms of the legal document, you've got a charter that is the governing document of a foundation. I've already mentioned the council and the beneficiaries. The last point just deals with the registered agent and the corporate filing requirements that a foundation will have to adhere to as a company. And at the bottom there, you see the common jurisdictions: Liechtenstein, Panama, Isle of Man, Guernsey, and the UAE. At Sovereign, it's important to stress that we can set up and manage foundations. We do not set them up in Panama or Liechtenstein. We set them up in Isle of Man, Guernsey, Gibraltar, and the UAE. So
Thanks,
over to Simon.
A bit of time constraints here. We mentioned Liechtenstein because that is the most dynamic in jurisdictions that have the most foundations registered, so we can facilitate that too. This a busy slide, ladies and gentlemen, a good case study. This is actually real, and this is for an Indian family that's moved out of India, and bit like my family that go from England to Malaga. It's only just over 2 hours. It's only 2 hours from go to India to the UAE. That family moved to the UAE, and they were particularly impressed with the free zones of DIFC and ADGM, DIFC being the most popular, Dubai International Financial Centre. So they wanted a corporate person. They wanted corporate personality. They wanted a registered entity, being a foundation. The founder, the non-resident Indian, contributed assets into the foundation. He and his spouse were beneficiaries. He and the spouse contributed assets to the foundation, and the foundation is structured for them both, their children, and their brothers from either side, brothers or sisters from either side, were asked to be a guardian, which is a bit like a protector of a trust. Purpose of the foundation was to own some cash and a local company, which caused them to get the immigration residency visas. And again, that company is involved with a bit like family investment company, planning cash at bank, some trading activities, and there's a separate entity for buying of real estate in the UAE, which we did through a Jebel Ali free zone company, again navigating around Sharia law, because the family originated from India, and they're non-resident of India, and they'll probably go on to eventually live in the UK when the kids start getting older into secondary school. Because of the not wanting to have all the eggs in the Emirati basket, notwithstanding that there's a terrible conflict in the region, which we all know about from the news. We obviously wish that would be resolved only too quickly. We decided, with the advice from the Indian tax specialist, that the beneficiary wouldn't be persons. It would be, like the previous case study, an offshore trust. Onshore could be Malta, midshore could be Hong Kong, or offshore could be Isle of Man or Guernsey. So the beneficiary was an offshore trust, settled by the same UAE resident, no problem in that. And then funds, liquid capital and other liquid and movable funds could be decanted into the offshore trust, fiscally neutral, outside and external to the UAE, and a pool and accumulation resource was there to benefit the parents and children and other family members. Offshore holding company for cash at bank, underlying strategic consultancy, trading, rest of world assets allocation, a bit like a family office situation. And although it looks complex, broken down, it's a foundation that has a trust as a beneficiary, and it wasn't even that expensive. Now, anyone that wants to raise questions, please use the chat box and put questions in. We'll take questions as we go. But we've got a couple of minutes to do family investment company, Lawrence. So over to you on that one. Next slide, please.
So just to whiz through family investment companies. So it obviously provides a mechanism for control to be retained with the founder, but beneficial ownership to be transferred across through the transfer of shares. They're used for tax mitigation, asset protection, and succession planning in conjunction with trusts. In the UK context, FICs are principally used for inheritance tax planning. The shares of an FIC have 3 distinctive features: voting rights, dividend rights, and the right to capital. And shares can be divided, so they only carry one or more of those rights. In relation to UK companies, the founding shareholder can be appointed as director and receive commercial remuneration for acting as such. Profits of a UK FIC can be rolled up, and with the tax charge limited to corporation tax on income and gains of the FIC. Generally speaking, that's 25%. Overseas FICs, Isle of Man, Guernsey, Hong Kong are generally the jurisdictions we use, suitable for founders who are UK tax, who are not, suitable for founders who are tax resident in tax-friendly states. So that's very important that you won't be able to set up one of these FICs for an individual who's living, say, as a long-term UK resident. That's not going to work. So if we just move on to the next slide.
Quick canter through the slide, because again, we'll take questions later. This is an offshore family investment company, but you could have a UK family investment company with the same hallmarks, the same strategy. But let's just take you through how it's structured. It's a glorified company. It is a company. It is a company that is registered offshore, perhaps in the Isle of Man or Guernsey, could equally be the UK for long-term UK residents, but the applicability here is persons living overseas or people going overseas and into a benign and tax-friendly arrangement or tax-friendly jurisdiction. So all we've done, we've made the founder head of family, could be both spouses, both partners, or just a single person. They would own all of the share classes to start with, A, B, and C, and they would concede and gift share class B to partner, spouse, or someone suitable. They would only have dividend discretionary rights. They'd have no voting or very limited voting rights, no capital, no growth rights, because they're of a certain age or more mature than the younger generation. The founder would give share class C. They would have discretionary dividend rights decided by the voting shareholder. Come back to them in a minute. They would have no or limited rights to votes. They can't crash the company, being a bit crude, but we've got limited time. But because they're 30 years younger, sometimes more, especially in my case, than their mother and father, they would have full rights to the capital and the growth. So as they're going to hopefully outlive their parents by 30 or 40 years, the value, the growth of the company, the growth of the business, all of the gains in that being growth and increase in value, that's assigned to the children. Can be infant children under nominee and adult children, non-nominee. Founder holds the rights to vote. So they still have control. And if it was a UK company, they could be the director. And no one's taking any influence and control away. They've got dividend discretionary rights and no rights to growth and very limited rights to capital. So the first two share classes are suppressed in value. So come the demise of the last surviving spouse, especially where there is inheritance tax in various parts of the world, the value of those shares are minimized, whereas the value of the younger generation share class is increased. And the family investment company has no limit to what it can do. It can own trading companies, it can offer consultancy services, it can buy and sell property, it can engage in traditional asset classes, get your will provisioning, get your bespoke particles association. That's what we do. Bit of life insurance perhaps, and that's the introduction of how a family investment company would work, both onshore and offshore, ladies and gentlemen. Right, Lawrence, pension planning, I think.
Yeah, this is just a quick.
Lawrence, sorry, I think that's
yeah.
a good junction. If you could just go back a slide, Miggs, while we're on the FIC.
Yes,
We have had a question from John. At what level of wealth is an FIC viable for clients who are UK domiciled, living in Spain, and have the option of choosing Spanish tax residency? If you could just quickly answer that before we move on.
Yeah, so it's not domicile anymore that's relevant.
Yep.
So they would be, it's for clients who are residing in Spain and they're a long-term UK resident. So they haven't clocked up their 10 tax years, generally speaking, of non-residents. So they're still subject to UK inheritance tax on worldwide assets, like UK DOMs previously were. I typically say 2 million is a minimum to justify the costs of structures. But having said that, if you've got assets which are likely to grow in value over time, as is often the case with, say, unlisted shares, where they're not worth much today, but they're likely to jump up in value, then the starting capital could be a lot less than that. But generally speaking, I normally say shoot for 2 million minimum.
Yeah, Lawrence, on that, point taken, but if the assets, yes, will grow in value and there's much more activity and different assets that can be contributed over time, I can tell you that a family investment company held for a Spanish resident, it would probably have to be a company registered in the European Union. not offshore, not on the Spanish blacklist. I've lived in Spain, so I know a little bit about this. And we have offices in different parts of Europe, especially Malta and Cyprus. Then the annual fees, John, good question, thank you, sir, would be less than €10,000, including an audit. So you wouldn't be putting in 100,000 and relying on that being a little property in Cornwall or something or elsewhere. The fees would be 10,000. So you've got to be, the contribution has to be appropriate, but it doesn't have to be enormous. I think that answers the question.
Yeah, and just one final point on Spain. Obviously, you may well have that the individual could be a Beckham user. I'm dealing with an FIC at the moment for a Beckham user in Spain, and they're setting up an Isle of Man FIC because that will work for 5 years while they qualify under that special regime. But after that, then it won't. They'll have to move somewhere else. So
the costs are not exhaustive.
Yeah, this is just a quick update on pensions, specific types of pensions. As many of you who are tuning in today for this webinar, the UK has announced that it's going to be removing the inheritance tax exemption for registered pension schemes, QROPs, and QNUPs and QROPs. And this is going to be coming in on the 6th of April 2027. The most recent draft was found in the Finance Bill that's making its way through Parliament at the moment, going to become Finance Act. It's currently very badly drafted legislation. It's going to likely to have to be revised before it becomes law next year from the 6th of April 2027. There are a number of planning options. We just want to highlight this at the moment and to highlight that there is going to be planning available. It's best if you're in a position at the moment with one of these pensions to just bear this in mind, and we will be writing to our clients with these pensions once the final legislation has been drafted. We will be writing to notify you of what the planning options are. The most likely planning option is to rely on the fact that you're non-tax resident for 10 tax years or more, so you're not an LTR. And that will be many clients with QROPs and QNUPs will not be LTRs because they will have clocked up the 10 or more tax years of non-residence. If you fall in that position, your pension fund should still be exempt from inheritance tax under the excluded property exemption. So that's going to be the main planning we're going to be looking at, but we won't be able to confirm that until the final legislation comes in. Another option for individuals with QNUPs is to switch over to a Guernsey-based international retirement pension plan, which we can do. You can't move from a QROPS into one of those, but you can potentially move from a QNUPs into one of those, and that should provide you with planning. Again, this is just to highlight this at this stage. We will be writing to clients, as I've mentioned, once we know what the final legislation is going to be. And on that note, I think that now concludes our slides. We've dealt with one question. It is over to Sovereign Insurance and to Chloe.
Thank you, everybody. Chloe Fitzpatrick, Director of Sovereign Insurance Services. We're a team based in Gibraltar, but we do service clients around the world, whether that's directly or with perhaps a partner broker. So wherever you or your client is based, we will be able to find a solution to work with you. We have our business split into two parts, which is private client solutions with tailored asset protection, very wealth-focused risk management, bespoke insurance portfolios, and then we have corporate policies as well, which comes into play for protecting your business from financial risks such as cyber attacks or legal action brought by a client or an employee. And again, on the corporate side, employee benefits, structure to attract and retain your employees and meet any local employer legislations as well. Next slide, please. So I'm going to start by taking you through the private clients and just give you a general overview. I'm going to try keep it more focused on what might be more relevant following Simon and Lawrence's intro there on their parts. So starting off with homes, valuables and motor, we will usually try and place multiple properties, vehicles and valuables into one encompassing policy, wherever that asset may be. This makes it easier for the client to add and make amendments as they sell or acquire new items. And we usually provide more high-end and tailored and robust protection than an off-the-shelf insurer. Usually the insurers that we work with will only work with a broker and will not partner with a client directly. So this is the benefit of having a broker that will manage your portfolio for you and keep track of everything on your behalf. Our clients often collect, for example, classic cars or supercars as investment pieces, or have high value art collections or jewellery and watch collections and precious family heirlooms. So items that have significant personal or financial value to themselves. We usually protect these items on a worldwide basis. So as you move around with your jewelry or your watches, or you change your art from one home to the other, the items are covered on a worldwide basis rather than just inside the home, which gives you an extra layer of protection and a lot more flexibility and freedom with that asset as well. The policies that we provide often cover liability for domestic staff that you may have, such as housekeepers, chefs or personal drivers, which is reflective of, again, you or your client's lifestyle. The assets can be covered on what's called an agreed value basis, which is different to sort of run-of-the-mill insurance providers where you might be able to buy that policy yourself online. The agreed value is quite a special point. At the start, where you add an item into the policy, for example, a piece of gold jewellery, you may insure it for £20,000 as long as the insurer agrees with that. Should the value of gold drop by the point that you may come to claim for that item, the item will still be paid out for that agreed value rather than depreciating it or paying out less. So it gives more peace of mind to you and your clients on your assets. We also work to provide a full concierge service, so including property valuations, risk management advice, and a quick turnaround time on claims processing. So when you first come to insure your property with us, we will arrange for someone to come and value the property and give you a list of requirements or recommendations to best protect your asset. This could be anything from including safes or smoke alarms to security gates and things like that. So that will all be provided in a report for you to review. We can also look at yacht and marine insurance as well for not only the vessel itself, and that can be for personal use or for charter. We can also provide medical insurance for the crew and accident cover for the crew and any passengers or guests that you may have. The medical element of this is key to make sure that your crew are treated quickly and that you're not missing staff on board for too long. And the accident cover is key to make sure that you're not sued in the event of someone having a slip or going overboard or cutting themselves on something aboard your vessel, that you're not going to be held personally liable for that. The insurance will be there to protect you. We can also provide travel insurance, which is highly important in today's climate with so many things going on. You never know when your flight is going to be delayed, lost luggage, and even if your holiday was cancelled or your business trip was cancelled, it's just to make sure that you've got financial protection and that you're not paying for flights again and again and again when they keep being delayed or moved or changed. Going on from what has been briefly mentioned by Simon and Lawrence with IHT, life insurance can be a product to protect against that as well. So it's often taken out to provide a lump sum to family members to protect from inheritance tax or maintain a level of lifestyle that your family are accustomed to in the event of your death. When calculating a sum insured for life insurance, people consider the IHT liability itself, any school or university fees, outstanding mortgages or debts, or any loss of monthly or yearly income that you would no longer be providing to your family. And for qualifying applicants, we can also look at specialist kidnap and ransom policies should you be in perhaps a hostile environment and something go wrong there. the policy would pay out for ransom. All of those policies are kept anonymously in our system and basically written by code, so that if there ever was a cyber attack on Sovereign, no one would be able to find out who was linked to that policy and therefore attack you. So it's all kept very secure in our systems. And then moving on to health insurance, which that can be tailored for a specific area of cover, whether that's worldwide, just Europe, just Africa, to suit the individual client. Even in the most basic cover for health insurance, you'll find full protection for high cost or high impact claims such as surgeries and cancer treatment. From there, you can choose to enhance your cover based on what's important to you, how far your budget stretches, or what your perhaps visa requirements for your jurisdiction. So you could add in dental, optical, health screening, maternity. And the benefits of health insurance is basically a lot of flexibility and a lot of speed. So have your choice of doctor or facility, and even the choice of country where you would receive your treatment. For example, you could reside in Portugal, but you may originally be from Hong Kong, and you may wish to travel back there to be close to your family and your friends for the treatment and recovery period, or you may have a trusted doctor in Hong Kong where you would fly back to have your treatment there. The speed of appointment time, as well as the flexibility of choosing your treatment time to suit your personal schedule or your work schedule, and be able to make plans around this. And oftentimes you will find that health insurance is a visa requirement for those relocating to new jurisdictions. I won't go into the specific requirements for each country or each type of visa. We could be here for hours. So if you do have any specific questions, you could maybe drop me a line and we can set up a call and go into more detail afterwards. Our high net worth clients as well often have children that choose to study abroad, and they may need a specific level of cover for only a short term, whether that's 1 month to 12 months, and then you can extend that as well up to 4 years if they were going to study for a couple of years abroad. So we can provide that, and you can choose to insure just yourself or your direct family members as well. And then I will quickly give you an overview of corporate clients and where we can support here. Again, I can't go into everything and all of the T's and C's of each style of policy, but just as a snapshot, professional indemnity is a key policy that you would need if you were looking to set up a company that provided services. Basically protects you if someone sued you for giving bad or incorrect advice. The insurance would step in and look to cover your legal costs or any settlements. Often having private professional indemnity shows a level of trust, a level of sort of respect that clients think that you're operating well, that you take that your mindfulness of risks that may occur, and they feel more comfortable working with you. And it can also be a regulatory requirement as well for companies to have this, again depending on type of business and depending on jurisdiction. Cyber insurance is key, especially in today's more digital age of things. It is needed by any organisation or individual who relies on a digital system, handles sensitive data, or engages in any online activities, as you may face potential risks associated with cyber attacks, data breaches, and other technology related incidents. Part of cyber insurance is having business interruption cover. That's key. The insurance can cover lost revenue and additional expenses taken to resume your normal business operations, and the cyber insurer will also look to settle any ransom that you may be asked for in a ransomware attack. And the insurer can often provide you a PR team to manage any negative press and spin that and mitigate it. So it's amazing to have the team on hand basically at your fingertips in the event that something does go wrong. It's very, very quick turnaround and very, very specialist support there. And with directors and officers insurance, that is essential for all individuals who serve in leadership or decision-making roles within an organisation. It protects you from your personal financial loss in the event that you are sued for alleged wrongful acts whilst managing the company. Many people don't know this, but your personal assets are at risk as well as the business assets when being sued for an action when working for a company. So having this type of insurance is really key. You shouldn't have to work hard your whole life to build up your assets and your own wealth to then have that taken away by perhaps a wrongful allegation from an employee. So please protect your personal assets whilst you're acting in a management or leadership role. And then I will try my best to cover the next part in just 1 minute. So that is commercial property. So this can include anything from an office space or a landlord portfolio of rented domestic or commercial units, properties held in a SIP, restaurants, shops and bars, warehouses, and even entire apartment buildings on behalf of management companies. We can cover loss of rent if something happens, such as a leak, and you need to move your tenant out. The insurer will pay for the missing months of rent there whilst it takes time to do the renovations and get a tenant back in. We can insure just the structure or the contents within the building as well. And where we would insure something like an office, we would try and layer that policy to include an additional item such as an employer's liability element or a public liability element, again to make things easier, simpler and quite often cheaper for the client to have that packaged in one place. And then I will just whiz on across to the next slide here with employee benefits. We've briefly talked about health insurance, life insurance and travel insurance on a personal scale. This would be for your employees on a group scale, very similar products and structures as for an individual, minor differences. But again, if you've got any key questions, do let me know and we can pick that up. That is insurance in a very small nutshell. If I can answer anything, I'll be more than happy to do so. Thank you very much.
Thanks, Chloe. We receiving quite a lot of questions in the background. We'll try and get to those at the end, but now we'll just pass off over to Gabrielle, who runs our Marine Services division, and then we'll have a case study and then get to the Q&A if we have time. Gabrielle?
Good morning, everyone. I'm the head of the yachting division of a sovereign group. It's a bit of a challenge to introduce you to a topic which is very big in such a short period of time. But the world of yachting is really a niche market. We are talking about luxury assets, movable assets, and rarely is seen as an investment. I have seen cases in which the clients have made some money, but is the purpose of the yacht is recreational. And just to frame the scope of the work we do, we generally work for yachts which are between 50 feet in length and 50 meters in length. The value is ranging from $500,000 to 30 or 40 million. That doesn't mean that we don't do below and above, but just to put you in context. And I think the yachting world is actually a very good example of mobility and layers of jurisdictions where you can find, for example, a Mexican guy buying a yacht from Turkey, using that boat in the Mediterranean Sea and having a Spanish crew on the boat, or maybe an Asian high net worth individual buying a boat from Italy and using the boat in the Caribbean with South African crew. And the flag could be probably British. So you see the layers of different jurisdictions that can play an important part of the consequences, how you own and how you operate the boat. And I think it is wise for yacht owners to seek some form of advice before buying the boat, at the time of buying the boat in the use, and then selling the boat. It's important to engage with people that have experience, that have been dealing and have seen a lot of cases, and can resolve and answer questions quickly. So how do we assess the cases we come across? We look at the legal and the fiscal, administrative, safe manning and technical aspects of the boat. From a legal point of view, clear ownership is really important. The fiscal element is probably the main concern of clients. And then safety on board sometimes is something that is not thought too much, but is key. It is key to have the right crew. It is key to have the right safety on the boat. And then clearly any technical issues. So, for example, we have, from a technical point of view, we look at the length of the boat, if it's above or below 24 meters in length, which is the threshold where usually you will see less or more requirement from the flag estate, and then also the gross tonnage. Talking about the registration of the boat, the registration is like a passport. So that will determine where you can sail and how easy it is to sail around the world. And a recognized flag estate, like for example the British flag, British law is international renown and reputable, and you will have an army of lawyers if you have a dispute or a claim on the boat. The company structure will assist with asset protection and planning, and will make certain things definitely much easier. For instance, we've seen clients where they decide to hold the boat in their own names, which is actually possible, but they haven't been able to obtain insurance cover because the legislation on which the boat was didn't allow them to access, for example, the London insurance market, or obtaining finance. Some banks, if you want to obtain finance for the acquisition of the boat, the bank has to feel comfortable with the legal framework under which the boat is. So I'm talking about the how we look at the dimensions and the use of the boat. There's a clear difference between operating a boat which is for pleasure use for your own, for the use of the owner, as opposed to chartering the boat, where the safety and manning has to be enhanced. And here usually is governed both by the international conventions, which is even common to the commercial shipping industry, as well as the yachting, and then the flag estate regulations, which will affect mainly the manning, the commercial coding of the boat, and some certificates that the flag estate will issue. As I said, one of the main reasons why a yacht owner would approach us is the tax, and the main tax we see is VAT. VAT is a consumption tax, and there's a misconception that by setting up an offshore structure you can avoid payment VAT. It's actually the people on board using the boat who are liable for VAT. And we see in many cases that are perfectly legit setups that you can use to save or to have a VAT exempt boat, but has to be properly set up. The most common is the temporary importation for pleasure use boats. That's when the user of the boat is not tax resident in the jurisdiction where the boat is being used. Then we have the commercial setup, which is for trading, and as any other business is VAT exempt on the hull. VAT will be charged on the charter fees that the clients and the passengers will pay. And then there's some leasing options available, especially in Malta. And then some banks can facilitate finance with some VAT reductions. As far as financial management, it is said that the value of the yacht is about 10%, which is a good reference. And that involves having a bank system that helps paying the crew, paying the expenses, some form of assistance with company accounts and management accounts, insurance, and generally all the finance management around the operation of the yacht, having in mind that a 10 million euro boat could be spending around a million euros a year. Crew is a very important chapter as well, and it's key to have competent crew on board. We can help with the crew employment contracts and some payroll facilities, as Chloe mentioned. Health insurance is key, and I think just to finish with my presentation, I think if a yacht owner has to seek advice, I think there are five stakeholders which are key in getting things right, which is company managers like Sovereign, a good lawyer that can give tax advice or legal advice, a broker which can help you choosing the right boat, a surveyor who will look at the technical aspects of the boat and make sure that the boat is in good conditions, and a captain. I think probably is one of the keys, having someone on board responsible and that you can trust. Over to you, Nick.
Thank you very much. So just to wrap up today's session, Simon's going to take us through a quick case study, which will incorporate all of what you've heard so far today. If anybody is keen to hang on after 11 o'clock, there will be some questions which I can answer then. Simon.
Thank you, Nick. And this is just to embrace everything we've spoken about and everything that's been delivered in the case study and much more we do every day and have done for the last 38 years. Case study, there's 3 business partners. One's resident Cyprus, that's Theo, second resident of the UAE, moving about at the moment, navigated the problems, but not wishing to leave, only temporarily. That's Sebastian, and Anne is a resident of Hong Kong and is still a British national. Their trio of expertise is linked to designing, building, consulting and delivering hospital, nursing home, growth industry, well-being, leisure, project managers and consulting in that area. They're quite well known, or they're known in that industry, a bit of IP, intellectual property, branding, protection, because IP can literally explode in value and can become a major key asset when a business is sold. The trading consulting entity needs to be separated, profits to be reinvested. They physically want all the cash out themselves. They're not greedy shareholders. They want to diversify. They know a lot about property, commercial property, but they're going to diversify into other property as an asset class. There's a bit of pension provisioning, and again the exit plan to materialize. So quick case study on the next slide, please, Miguel. And this, what it looks like. You've got Theo, resident Cyprus, Sebastian, resident of UAE, and Anne, resident of Hong Kong. Take the top line because that's their private investment planning. It's all in corporates. It's limited liability. It's fiscally stable. And even if an offshore trust is set up for Theo because he lives in Cyprus, a classic non-dom regime where overseas income overseas income is not taxed, capital gains is not taxed, and inheritance tax is quite benign in these jurisdictions. So you could, he's resident of Cyprus, we're setting up a trust in the EU or in Guernsey, and he is keen on art, jewelry, antiques and collectibles, which can be directly held by the trust and insured just in case there's any damage and theft, unlikely where he lives. Cash at bank, Sebastian living in the UAE, he's got a car collection, which is quite often the case with wealthy entrepreneurs, bit of cash at bank. And Anne likes her yachting, and because she sails in some choppy waters, there's a life insurance and vessel policy held within her offshore family investment company. She can't have a trust because she's not been non-UK resident for 10 years, because then there's a tail from when you depart from the UK following you up to 10 years. After 10 years of non-residence, yes, you could have a trust rather like Theo's trust, but she's got an overseas family investment company, either registered in Mauritius because she's been there before, or the Isle of Man, highly dependable. And the yacht is owned by that upper company. Below the structure, there's a group holding company where all beneficial owners are all beneficial owners are enjoying a share in the group holding company, and through that there's some medical, travel, life policies for partners and executives. The line below that is the trading activities. Singapore company used for trademark, patents, IP and future license exploitation because it's a territorial tax system. Singapore has signed over 50 tax treaties. It's stable, it's vibrant, it's positive, it's not blacklisted. Maltese trading company, that's for the project design management consultancy. You could align a Maltese trading company for quite a mixture of different activities. Doesn't have to be healthcare. And that Maltese trading company is owned by the group holding company in Malta. As such, you've got the lowest tax rate in the EU, 5%, and it's EU endorsed, EU applicable, and not under attack. And a UK company is on the side of there because it's reinvesting into commercial property insured as well. Just at the side of the Maltese holding company, there's an international retirement pension plan because there's certain executives they want to look after, plus themselves, and there's an international pension plan that the Maltese company is sponsoring, and the beneficiaries is perhaps the workforce. Singapore company, territorial tax regime, no capital gains tax, no corporation tax as long as there's no territorial income. Malta, 5% corporation tax, single economic unit. In the EU, onshore, tax-friendly. UK company, yes, there's no dividend withholding tax. We don't have withholding tax in England. And trust, foundation and FIC remain fiscally neutral. The foundation could be established in the UAE. And one of the questions was, what is the tax position of foundation in the UAE? A foundation in the UAE cannot trade commercially like the Maltese trading company. It can own assets, it can own companies, it can own trading companies. So in this case, or the case before, the trading companies would be exposed to taxation in the UAE because there's a UAE trading company, corporation tax at 9%. Dividends, gains, and that type of income should not be exposed to UAE taxation, just the underlying activities. That, ladies and gentlemen, is your case study, and some of that is rather relevant. Perhaps 3 case studies in one, but this is what we do and have done for the last 38 years. Nick.
Thank you very much, Simon.
Just one point on the dividend withholding tax on that. So that will not apply because you've obviously got in that structure that Simon's just gone through. The dividend is being paid to the group holding company, which sits in between the trusts.
Yes.
It's not, if you have a dividend paid from a UK company to a trust and there's a UK resident beneficiary, then there is withholding tax. So it's important to note the way that's been structured, that you've got that company interposed between the foundation, the trust, and the underlying companies, one of which is a UK co.
Thank you, Lawrence. Have we got a couple of minutes for questions, Nick?
We are now out of time. I will go through the questions that have been asked for those that want to stay on, but I know that a lot of you will start dropping off now as we have gone over. But I just wanted to let you know that as a reminder at the start, the slideshow will be sent to you together with the recording. If you've asked a question or if you have any further questions, please do get in touch. We will be in touch with you after the session. Those of you who've asked a question and we haven't been able to answer them, so we will be in touch with you. Next session we will be running is at the end of April. Does anyone have the exact date? I can't remember it, but I think it's the 25th of April, I believe. But we will be in touch with you. 28th of April. Thank you very much, Jesse.
Thanks, Jess.
It will be the topic of the third webinar will be on international company formation and management. Again, the tax element is a running theme. That will be the focal point, but we will be adding other elements to this, one being retirement planning, which, as we said at the start, we'll be going into more detail on. Just a couple of very quick questions. Sonia, Simon's just answered your second question, but your first question, which is largely to Lawrence and or Simon, what are the options for non-UK residents who have standard company UK pensions and have not yet clocked up their 10 years outside the UK? Are you able just to quickly answer that one?
Lawrence.
Yes. So yeah, I mean, it depends on the final legislation, but if you haven't clocked up the 10 years, what you typically want to do is to pull the pension out and rely on the flexi access regime. So if you've got a Malta QROPS or indeed a UK SIP, then both of those regimes you can pull out as flexi access. So that means you could take a PCLS typically of 25%, and then you can take the balance out in a single payment. Now that effectively allows you to extract all of the pension fund. What you need to watch, of course, with that planning is where you are resident. If you've got a UK registered pension scheme, a very good solution at the moment is to go to a treaty jurisdiction. The best jurisdiction for this is the UAE, and you rely on the tax treaty between the UAE and the UK. And at the moment, you can pull out the UK pension without any tax in the UK or indeed in the UAE as things stand at the moment. But you do need to make a HMRC claim. And then effectively, you've extracted, you've taken all of the fund out of the pension and turned it into clean capital. If you're doing that planning, you've got to remain non-resident for a minimum of 6 tax years, generally speaking. Similar planning is available, as I've said, with Malta if you've got a QROPS, but again, you need to check the tax position there in Malta firstly, and in your country of tax residence. But aside from the 10-year planning and relying on the EPT exemption, the other planning would be to look at this DTA planning if you've got those UK registered pension schemes or indeed a Malta QROPS.
Good stuff.
Yeah, I mean, but basically we're going to be waiting till the final legislation is published, and then we're going to be writing to all of our clients with these affected pension schemes at that stage and recommending tailored tax advice for those who want it.
Thank you, Lawrence. One final question before we wrap up once and for all. This has come from Namik. Thank you for the presentation. I'd like to ask, what would be the best structure against CRS and AEOI for a Turkish national if she decides the dividend and wants, and what are the pros and cons between a trust and foundation? Lawrence, Simon?
Yeah, I mean, in terms of on the CRS point, I think you have to be quite careful there because obviously CRS is just a reporting regime.
Yeah, there's nothing you can do about it.
We don't offer solutions to circumvent CRS because that wouldn't be right. I think with CRS, what you just need to ensure is that the correct CRS reporting is done. I've seen some cases where you have multiple reporting to different revenue authorities, which obviously you don't want. You want to obviously limit your exposure to CRS, but to try and say it's not going to apply and to structure something so there's going to be no reporting under CRS is unrealistic. And we don't operate in jurisdictions which haven't ratified CRS. I think all of the jurisdictions that we operate in have ratified CRS, I think. Don't hold me to that, but I think that's certainly the general position. There's only a few jurisdictions that haven't ratified CRS, and it's very, very hard to get bank accounts set up in those jurisdictions. So I think you just accept CRS, but you just manage it and ensure that you're not over-reporting under it. I think the best thing, as we always say with CRS, is just ensure that your structure is tax compliant. So if structures are being set up for tax planning reasons, they should come with tax advice. And then if the revenue authority challenges the legitimacy of the structure, you have that tax advice in place to defend it. So if the revenue authority assess you, you're in a position then to defend it. And we obviously operate now within an age of full transparency and disclosure, generally speaking. In terms of the pros and cons of foundations and trusts, trusts, certainly for UK planning, which is what Simon and I are involved in, we always favour trusts because foundations, as I explained earlier, are not recognised under English law. So if you're doing, say, excluded property trust planning, whilst it's possible to use a foundation, you're much better off to use a trust because you know where you stand. Conversely,
Lawrence,
if you,
go on. Sorry, just finish. I've got something else for Turkey.
Right. So conversely, if you're residing in a civil law jurisdiction or you're from a civil law background, then it's likely that you're going to want a foundation because of that corporate structure that you have in place, rather than it being this division between legal and equitable ownership. So it kind of depends on your background. But again, if you're using it for specific tax planning reasons, then you may need one or the other. But as I say, for UK purposes, we would always favour a trust over a foundation for UK tax planning.
And
Sorry,
just closing on that, Lawrence, knowing that Namik, good morning, Namik, is a gentleman from Turkey, from experience, from good collective experience and dealing with Turkish advisors, and you could say the same for the neighbouring countries, where we have materialised business thanks to our network in those countries. Not just a trust for Turkish residents, but the advantages of a private trust company, a PTC, is a practical, solid, respective structure, not incorporated in a tax haven, managed and controlled carefully, perhaps outside of Turkey, with the PTC operating as a trustee for that family, so the family get their own trust company, and because you're not offering the trustee service to the general public with their trademark featured, it's just for the family. The PTC private trust company is the ultimate, the Rolls-Royce, the Aston Martin, the Lewis Hamilton Formula One of trust planning. So again, we've got a slide on this. We might have used it in the last talk. I've got further information if you want it. Again, this is what we deliver and have done for our 4 decades, and further information is available upon request. But thank you, Namik, for that challenging question, sir.
Thanks all. And on that note, I think we will end today's session. Thank you all for attending. Thank you for those of you who've stuck around to ask some questions. We look forward to speaking to you again on the 28th of April. The session will be sent to you, the recording will be sent to you, and more information about the next and final webinar will be sent in due course. Have a lovely day, and thank you very much to our speakers. Goodbye.
Thanks, everyone.
Thanks, everybody.
Thank you.
Bye-bye.
Bye.
Bye.
Thank you. Bye-bye.
Bye. So we've got 50 on the line.